quantum computers will steal Bitcoin, and even Musk is panicking? Bitcoin and Ethereum are bleeding heavily, and ETFs have withdrawn $7 billion in 3 days. Are institutions going to run away? How accurate is Bitcoin's August curse? It's only seen 4 price increases in 12 years. What are your thoughts on this year? Institutions and big investors are taking advantage of the decline to buy stocks crazily. Are they trying to catch Ethereum's wealth express? Stablecoins want to be financial influencers? The Genius Act says, no way. They can only be used as payment tools. Pump.fun's revenue in July plummeted. Are all the dogs and cats on Solana shutting down?
Tuesday, August 5th, BitcoinTV English channel. Where is the coin chain? I'm Michael, starting with the 24-hour cryptocurrency headlines. This time, Musk didn't call for going to Mars, but instead worried about Bitcoin. His AI Grok asked, if quantum computers are truly developed, will they break Bitcoin's encryption? IBM, quite coincidentally, just announced a 2,000 qubit system by 2033, sending the tech world into a frenzy. Grok said there's no risk within 5 years, with a less than 10% risk before 2035, even switching to SHA-3. However, Deloitte warns that approximately a quarter of the world's Bitcoin could be stolen by quantum computers. Musk is understandably panicked. After all, he, Tesla, and SpaceX collectively hold $2.2 billion worth of Bitcoin. As of August of this year, institutions controlled over 3.31 million Bitcoins, with a market capitalization of $135 billion and 15.8% of the global circulating supply. ETFs held 1.4896 million of these, and Strategy alone held 629,000. You have to know that 18 months ago, institutions only took a mere 4%, and now it has more than doubled. Even if you don't believe in Web3, you have to believe in this rhythm of real money. Volatility reflects the risk and stability of an asset. For investors, lower volatility means greater peace of mind. Since the launch of spot ETFs, Bitcoin's volatile performance has calmed considerably. Its 90-day annualized volatility has fallen below 40% for the first time, having soared to over 60% upon its initial launch. A comparison with gold is even more striking. Previously, Bitcoin's volatility was over 3 times that of gold, but now it's less than 2 times. According to data from the first quarter of 2025, Bitcoin's annualized volatility was approximately 52.2%, while gold's was 15.5%, a narrowing gap. This also demonstrates the maturation of the market, with greater institutional investment and retail investor confidence, solidifying Bitcoin's status as digital gold. This transformation from a speculative asset to a valuable asset is a clear signal of regulatory compliance and mainstream adoption in the crypto market. Institutional investors are fleeing the market again. At the end of July, US spot Bitcoin ETFs saw a single-day outflow of $324 million, marking the 3rd consecutive day of net outflows. This suggests investors are becoming increasingly cautious and on the defensive. IBITA alone withdrew $292 million, shouldering nearly 90% of the selling pressure. FBTC and GBTC were not far behind, with outflows of $40.1 million and $99 million, respectively. While BETB saw a small inflow of $18.7 million, this was insufficient to save the market. Meanwhile, the Ethereum spot ETF suffered even worse, experiencing a $466 million outflow in a single day, reaching a nearly 1-month high. Major investors in Ether saw a massive outflow of $375 million, while Ethe saw an outflow of $28 million. Even FETH saw a total withdrawal of $55.1 million. This wave of losses for both Bitcoin and Ethereum is a double-edged sword. Institutional investors, sensing market instability, are quickly reducing their positions to lock in profits and avoid being trapped. Now that ETFs are no longer backing stocks, the spot market support has weakened. If the market continues to fall, the next wave of volatility may indeed arrive. Therefore, it will be important to closely monitor the flow of funds into these ETFs over the next few days to see if they are still fleeing for their lives. Please like and follow us for the latest developments in the cryptocurrency, blockchain, and mining circles within the next 24 hours. Click the bell to join our channel and become a member. You'll receive your membership code Monday through Friday. Folks, the rich dad, poor dad guy is back at it again. Just as everyone was frantic about Trump's tax hikes, whether the Federal Reserve would cut interest rates, and whether the US economy would experience a recession, he suddenly made a bombshell post on X. Hope the Bitcoin August curse comes true. He also casually asked, will it fall below $90,000? This statement instantly sent the cryptocurrency world into a frenzy.
Data shows that from 2013 to 2024, August has been a mostly down month for Bitcoin, with only 4 years recording positive growth. The largest increase was 65.32% in 2017, and the smallest was 2.83% in 2020. While most other years saw declines, the magnitude of the declines was relatively manageable, with the largest being 18.67% in 2015, and the smallest being 4.6% in 2019. This demonstrates that while the August curse is common, it's not always fatal.
This is kind of a historic entry point because all of the risk has been stripped off the asset.
What is the Bitcoin August curse? It refers to the fact that every August, Bitcoin tends to fluctuate and fall. This time was no exception. The disappointing non-farm payroll data sent Bitcoin plummeting from $119,000 to $111,800. Although it later rebounded to $114,700, the drop was still quite dramatic. While Bitcoin held up well, altcoins suffered. Liquidations and capital withdrawals combined to crush the market, highlighting its fragility. Funds are currently flowing from Bitcoin to Ethereum. On that single day, the Ethereum spot ETF attracted $533 million, demonstrating a quiet shift in institutional investors. Just as the weekend's pullback began, the old whales returned. Monitoring shows that around 3:30 p.m. yesterday, a veteran Ethereum investor, whose average cost was only 31 cents, suddenly pulled 13,600 ETH from exchanges, equivalent to $47 million, effectively draining his wallet. He currently holds nearly 60,000 ETH on-chain, with a total market capitalization of approximately $210 million. Crucially, Ethereum is currently trading at a relatively high $3,560. This individual, who was busy selling throughout last year, is now quietly buying back. Doesn't this clearly indicate he's sold out and is now looking to buy back in?
On-chain analysis shows that over 200 new Ethereum whale addresses have been added over the past 30 days, each holding at least 10,000 ETH, primarily from exchanges, custodians, and ETF products. Arkham also exposed a large investor who transferred 79,461 ETH through Galaxy Digital OTC over 3 days, with a market value exceeding $280 million. Dune data also shows that holdings in Ethereum ETFs have surged by over 40% over the past 30 days, indicating a significant acceleration in institutional buying.
Ethereum's recent rise is not just random, it's called institutional giants all get on board. Not only retail investors are rushing in, but even big bosses in the asset world like BlackRock have also rushed in, and their Ethereum ETFs raked in $1.7 billion in 10 days, a veritable ATM. This buying spree wasn't simply bullish, it also had the White House's endorsement. Fresh off the release of its policy report, it announced support for financial blockchains. Major Wall Street banks, upon conducting research, decisively chose Ethereum as the foundational blockchain. In other words, Ethereum is no longer just a cryptocurrency toy. It's now the underlying engine of financial restructuring. Investing in the future without jumping on board is a shame.
act stirs up trouble, SuFi and DeFi from now on, everyone will do their own thing. Are they forcing the US dollar to split? Tokens halved in 12 days plus empty airdrops. Is this a suicide truck operation by Pump.fun?
After taking office, Trump truly incorporated cryptocurrency into his governing agenda. On July 18th, shortly after the House of Representatives passed the Digital Asset Market Clarity Act, he immediately signed the Genius Act in the White House, setting regulatory boundaries for dollar-pegged stablecoins. But do you think this marks the beginning of a new era for stablecoins? Don't be naive. The Trump family even launched their own $1 stablecoin, which immediately raised concerns among Democrats. Are you setting policy specifically for your family? This wave of actions has made cryptocurrency policy seem like a hidden threat. While it's a positive development, be careful not to step on the landmine.
The Genius Act stipulates that stablecoins must be pegged 1:1 to the US dollar in high-quality, low-risk assets, such as US Treasury bonds maturing within 93 days, insured bank deposits, and physical cash. Issuers must undergo regular audits and disclose their reserves monthly. The Act also prohibits these payment stablecoins from paying users income or interest.
Well, there was a lot of concern from community banks that if stablecoins were paying 5% interest, it would put them out of business. I think that concern, although understandable from them, I don't think that that's what would have happened. But these are the types of compromises, quite frankly, that you need in order to pass legislation.
Stablecoins have really been weaned this time. Originally, they were a super bridge between traditional finance and the blockchain industry, and their market size had soared to $200 billion. However, banks, fearing that their jobs would be in jeopardy, entered the market early to lobby. In the past, stablecoins could attract users by paying interest. But now the Genius Act, with its sweeping impact, has directly shattered the dream of both institutional and retail investors of passive profits. With interest rates banned and returns eliminated, who would still want to profit from it? This wave of investment has directly channeled funds into money market funds, MMFS. To put it bluntly, traditional finance has lost. Last December, memecoin was incredibly popular, with its market capitalization reaching $137 billion. Pump.fun also took off, riding the wave and collecting daily transaction fees, making a killing. Unfortunately, the good times didn't last long. As soon as the hype died down, the platform plummeted in March, with its market capitalization shrinking by 60% to just over $53 billion. The market cooled and investor enthusiasm waned. Pump.fun, which had previously relied on issuing tokens and earning fees through transactions, saw its revenue plummet, leaving it nowhere near its former glory.
Judging by the data, Pump.fun's revenue has been plummeting. It dropped to $90 million in February, then to $37 million in March, and then hovered around $40 million for the next few months. By July, revenue had plummeted nearly 80% from its January peak, hitting a new low for the year.
Do I think that the lack of an airdrop or the lack of allocation or the price or this and that? Yes, because it's the internet. Everyone's going to be upset. Like, as an example, hear me out on this thought exercise. Imagine if Pump.fun just get 100% of their tokens as an airdrop. Somebody would complain about that they didn't get enough or what. It's just impossible to please the internet.
In fact, on July 23rd, the market capitalization of memecoin rebounded to $85 billion. However, the good times did not last long. From July 28th to 29th, Pump.fun's daily revenue fell below $300,000 for the first time since September 2024, a 92% drop from its peak.
This plot twist is truly remarkable. Pump.fun has literally free-fallen from the top. Its market share plummeted from 88% to 13%, only to be snatched up by up-and-coming startup Let's Bonk, which surged to 86% in a resounding success. The key issue isn't just the aggressive competition, but also Pump.fun's own performance. The platform token has plummeted 60% in 12 days, and the airdrop, despite much talk, hasn't materialized, leaving users disheartened. Ultimately, however, it remains one of the highest-grossing DeFi projects on Solana, demonstrating that while memecoins may be losing ground, established players haven't completely collapsed. This wave of activity warrants a thorough review of the entire industry.
British programmer James Halls searched through the garbage dump and finally found the old hard drive worth $950 million. It is suggested to change the name to Bitcoin version of the Old Man and the Sea. Trump was thrilled by the Dow Jones Industrial Average's 585-point surge, tweeting "Make America Great Again" overnight. Netizens responded with a sly comment. "Mr. President, is this a bull market announcement? From now on, you can watch how the wealthy spend their money at fees.pump.fun. Daily income plus token purchase data is fully transparent. It is recommended to eat it with lemon for better results." In response to rumors of a secret coin issuance, JD.com's CoinChain Technology issued an official statement. "License application pending, no queuing." So, is this a direct challenge to Alipay for the digital dollar? The boss of the Korean exchange Bitsonic has been jailed for the second time, with an additional 6 months in prison for defrauding 160 million won. Together with the 7-year sentence in the previous case, he has completed the 7-year itch luxury package.
Last December, memecoin was incredibly popular, with its market capitalization reaching $137 billion. Pump.fun also took off, riding the wave and collecting daily transaction fees, making a killing. Unfortunately, the good times didn't last long. As soon as the hype died down, the platform plummeted in March, with its market capitalization shrinking by 60% to just over $53 billion. The market cooled and investor enthusiasm waned. Pump.fun, which had previously relied on issuing tokens and earning fees through transactions, saw its revenue plummet, leaving it nowhere near its former glory.